Just keep buying. Part 3. Why one stock can sink your future? At 11 o'clock at night, Rohan saw the stock of his favorite company falling on the mobile screen. In a few hours, a large part of his savings from many years had disappeared. That company was famous, its products were in every home, and experts were describing it as a winner of the future. Then a piece of bad news came, and trust turned into fear. The most dangerous thing was not the decline. The real fear was that Rohan was just not able to understand. Was his analysis wrong, or was he just unlucky? In the previous part, we saw that investing does not mean only buying stocks. Bonds, property and REIT, every asset can play a different role in your portfolio. Stocks can give growth, bonds can add stability, property can give rent and control, while REITs make access to real estate easy with a small amount. But every asset has its own price. With growth comes fluctuation, with stability lower returns, and with property the problem of maintenance, debt and liquidity. That is why the biggest lesson of Part 2 was, do not bind your future to any single place. The job of diversification is not to give a guarantee of returns, but to limit the damage of one mistake. From right here, today's question is born. When stocks can build wealth in the long run, why not earn more by choosing the best company instead of buying the entire market? Hearing it, this path sounds straightforward. Buy the share of a company, become a partner in its business, and if it grows, your capital can also increase along with it. And yes, it is possible to earn returns higher than the index from an individual stock. There have been such winners in history. The trouble is not the probability of winning, it is identifying the winner beforehand. 𝐮𝐸𝐿𝐴 looks at this difficulty from two perspectives. The first is the financial argument. When professionals working full-time cannot continuously beat the benchmark, how big will the challenge be for an ordinary investor? Professional fund managers have analysts, data, management meetings and research tools. Still, their edge is not permanent, because the person opposite in the market is also often equally prepared. The recent conclusion of the SPIVA India report by S&P Dow Jones Indices teaches caution. In the short term, results were mixed, but in the long term, most active categories lagged behind their benchmarks. This does not mean that no manager can ever win. It means only that choosing continuous winners is rare, and a past victory is not a guarantee of the next victory. Then come fees, brokerage, bid-ask spread, tax and the cost of your time. A small difference can become big in years of compounding, so comparison should always be after expenses. A benchmark is not an imaginary opponent. It shows what is received from a simple, diversified option in the same market. If even after hard work one lags behind it, then the hard work proved expensive. Now understand a strange truth of the market. The return of the index is not formed by the equal success of thousands of stocks. Often a few extraordinary companies pull the wealth creation of the entire market forward. In the famous research of Professor Hendrik Bessembinder, it was found that after 1926, the total net stock market wealth creation of the US could be explained by the most successful approximately 4% of companies. This is often stated in a wrong manner, that only 4% of stocks beat treasury bills. The correct point is this, that small group created the net wealth creation of the market. Meaning, the market can go up, while many individual stocks give ordinary returns, disappear or cause losses. Behind the average return, an extremely unequal distribution of results remains hidden. Now imagine, among thousands of companies, who will be those same big winners of the future? Their identification has to be done when success is not clear, competition is sharp, and the future is blurry. By the time the winner becomes visible to everyone, its popularity has often already been included in the price. Then you can buy a spectacular business, but it is not necessary that a spectacular investment is also received. This is the difference between a great company and a great stock. The company can grow rapidly, yet a share bought at a very expensive valuation can disappoint for years. Behind the face of a business visible outside can be hidden debt, regulation, fraud, technology disruption, management conflict, and changing consumer taste. Every risk is not clearly visible in the balance sheet. A temporary decline of the market and a permanent loss are not one. A diversified index can recover after falling, but it is not necessary that the share of a bankrupt company ever returns to its old price. There are weak companies too in an index fund, but along with that, there are also those potential big winners which you could have missed choosing alone. This is the real strength of diversification. A broad market index keeps changing with time. The weight of growing companies can increase, weak companies can decrease, and the rules of the index give a changing economy a place in the portfolio. The company list of an old index and today's list do not look the same. This does not mean that every removed company was ruined. The point is just that leadership is not permanent. While looking at history, we also become victims of survivorship bias. Today's champions are clearly visible, but the stories of hundreds of companies that started with them and ended are often not heard. Social media strengthens this illusion even more. People show their stock that has increased 10 times, but leave loss-making pics, closed accounts, and restless nights behind the camera. Now comes the second, and perhaps more troubling question, the existential argument. Suppose your chosen stock has gone up. How will you know that it was skill, not luck? A good return of 1 year is not proof. During that period, the entire sector might have risen, interest rates would have changed, or some such news would have increased the price which you did not estimate. In a bull market, a rising tide lifts many boats. At that time, it is easy for the portfolio to grow. The real question is, did you do better than a benchmark with equal risk? Sometimes a sector suddenly becomes the favorite of the market. If your pick was in that very wave, then the return would have come less from your company research and more from the broad trend. To identify skill, many independent decisions, a long time, and honest records are needed. But even then the market regime can change, therefore the final answer is often not completely clear. In a correct comparison, dividends, fees, taxes, idle cash and trading costs should be included. Looking only at the price gain visible on the app and considering oneself better than the market is an incomplete calculation. Along with return, measure risk too. If to earn a little more the portfolio tolerated a very deep decline, then its experience and result cannot be truly better than the benchmark. There is one more problem: the investor keeps changing the rules. If the stock fell, the strategy was called long-term. If it rose, it was proof of one's intelligence. Such changing yardsticks do not let skill be measured. A good result does not always come from a good process. A wager made without examination can win, and a decision with deep research can lose due to an unknown event. Understand this as outcome bias. We decide the quality of a past decision looking at the result, whereas in investing, a correct process too can sometimes give a loss, and a poor process too can sometimes give a profit. After a few wins, confidence can become overconfidence. The investor makes the position big, leaves diversification, and just then one wrong estimate erases the benefit of the previous several correct decisions. Familiar companies feel safe to us. But using some brand every day is not equal to understanding its future cash flows, competition, and correct valuation. If you also work in that same company and hold its shares, risk can connect double. Job and investment both become dependent on the condition of the same business. Millions of investors keep an eye on public information. Reading some annual report is useful, but getting a unique edge from it is difficult because that same information can quickly be included in the price. And trading on the basis of material information that is not public can become a legal problem. Therefore, a sustainable edge is something far more difficult than a secret tip or a friend's whisper. This does not mean analysts and stock pickers are useless. Their buying, selling, and research help in price discovery. Passive investors too use the prices received from that active market. The question is whether your retirement, children's education, or home savings should depend on that difficult competition. Entertainment money and financial security money are not the same. A broad index fund gives a simple answer here. Instead of estimating the future of one company, it lets you take part in the collective growth of many businesses, generally with less hard work. But an index fund is not risk-free. The entire market can fall, the weight of some country or sector can be high, and recovery can take a long time. Diversification reduces pain, it does not erase it. Therefore, having index written in the name is not enough. A narrow theme fund too can be focused on a few companies. A broad, low-cost and understandable index is a different thing. Expense ratio, tracking difference, liquidity, and which index the fund follows. It is necessary to look at these details. A cheap choice can be good, but just being cheap is not sufficient. So should individual stocks be completely forgotten? Not necessarily. If you like business research, it can be kept in a limited portion for learning or interest. Some investors adopt a core and satellite method. The large core remains in diversified funds, while a small satellite is for individual thoughts. The correct proportion depends on every individual situation. The loss of the amount experimented with should not affect the emergency fund, necessary goals, or sleep. This is not a rule of a fixed percentage, it is a principle of handling risk. For every stock, first write, why are you buying, which point will prove the thesis wrong, what is the valuation, and how big will the position be. The later story should not change the earlier logic. putting borrowed money, emergency savings, or money needed in the near future into individual stocks increases danger. The market does not recover looking at the date of your bill. Upon receiving employee stock or ESOPs, concentration can quietly increase. If salary, bonus, and portfolio are connected to the same company, then paying special attention to diversification is wise. Selling a big concentrated holding can have effects on tax and timing. In such a situation, instead of haste, understanding rules, and if there is a need, taking advice from a qualified advisor is better. Review the portfolio, but do not look at the price every hour. The direction of business changes slowly, whereas the noise of the screen tempts emotions every second to buy and sell. Ego can stop from selling a stock with a loss, and fear from selling a winner. A pre-decided process does not eliminate these emotions, but it stops the steering from going into their hands. The most hidden cost of stock picking is time and mental peace. Hours spent between research, news, and results are also a price, even if they do not appear in the brokerage statement. The message of this chapter is not that wealth is built only from the index. The message is that rather than choosing the rare winners of the market beforehand, it is easier to have them near you in a diversified portfolio. This is the practical meaning of just keep buying, not blindly keeping on buying a favorite share, but rather adding diversified assets regularly and in a disciplined manner according to goals. Yet a puzzle remains. Suppose you chose the right index fund and the right asset mix, but the market is currently at a record high. Should you invest today itself? Or will it be better to take cash and wait for the next decline? In the next part, we will know the truth of this very decision: invest now, deploy gradually, or wait for the perfect dip.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.